Welcome to our exploration of monetary economics, a field that examines how money, prices, and interest rates shape the economy. In this video, we'll journey from the earliest barter systems to the complex monetary structures of today. We'll uncover the essential functions of money, its evolution, and its significance in different economic systems. By the end, you'll understand not just what money is, but why it's so crucial for trade, specialization, and economic growth. Let's begin by looking at the origins of exchange before money existed. For money, people relied on the barter system, directly exchanging goods and services. Imagine trading a horse for a cow or 3 sheep for 4 goats. Barter was common in primitive societies and still exists in some rural areas today. However, this system required a double coincidence of wants. Both parties had to want what the other offered. While simple, bartering was time-consuming and often inefficient, especially as societies grew and needs became more complex. Barter system faced several major challenges. First, finding someone who wanted what you had and had what you wanted was rare. There was no common measure of value, making it hard to agree on fair trades. Indivisible goods like a horse couldn't be easily split for smaller exchanges. Storing value was tricky as goods could spoil or lose worth over time. Deferred payments were unreliable, and the lack of specialization meant people had to be self-sufficient. These issues limited economic progress and made trade cumbersome. Money emerged as a solution to the problems of barter. It is a medium of exchange widely accepted for goods, services, and debts. Money can take many forms: physical currency, bank deposits, or even digital currency. Its value is influenced by supply and demand, government policies, and market conditions. Ultimately, money's true meaning lies in its ability to facilitate economic activity and improve living standards for individuals and society. Economists have long debated the definition of money. Prof. A. Walker famously said, "Money is that money does, but this is too vague." Prof. Crowther offered a more complete definition. Money is anything generally accepted as a means of exchange, a measure, and a store of value. This definition captures the essential functions that make money indispensable in modern economies. Story of money's evolution is fascinating. The word money comes from the Latin moneta, the Roman goddess in whose temple coins were made. In early societies, money took many forms: animal skins in hunting societies, livestock in pastoral communities, and grains in agricultural ones. As civilizations advanced, so did the forms of money, reflecting the needs and resources of each era. First stage in the evolution of money was commodity money. Early humans used items like stones, spears, bows, and animal skins as currency. These commodities had intrinsic value and were widely accepted within their communities. The use of commodity money marked a significant step forward from barter, making trade more efficient and laying the groundwork for more advanced monetary systems. As societies grew and trade expanded, metallic money replaced commodities. Metals like gold, silver, copper, and tin became standard currencies. They were durable, easy to transport, and could be divided into smaller units. Metallic money made large-scale trade possible and was adopted by many ancient civilizations, including the Greeks and Romans. Next major development was paper money. It began with goldsmiths who stored gold for others and issued receipts as proof. These receipts became widely accepted as substitutes for gold, leading to the creation of paper money backed by precious metals. Eventually, banknotes emerged, making transactions even more convenient and secure. Modern economies introduced credit money such as checks. Unlike banknotes, checks are written orders to transfer money for specific sums and single transactions. While not money themselves, checks facilitate large transactions and reduce the need to carry cash. This innovation made commerce more flexible and secure, especially for businesses and institutions. Final stage in the evolution of money is near money. These are financial instruments like bills of exchange, treasury bills, bonds, and savings certificates. While not money in the strictest sense, they are highly liquid and can be quickly converted into cash. Near money plays a crucial role in modern financial systems, offering flexibility and security for both individuals and businesses. Money's primary functions are twofold. First, it acts as a medium of exchange, making transactions smooth and efficient. Second, it serves as a measure of value, providing a common standard for pricing goods and services. These functions allow buyers and sellers to easily compare prices and make informed decisions, which is essential for a thriving economy. As a medium of exchange, money separates the act of selling from buying. This means you can sell your goods or services and use the money received to purchase anything else you need. This flexibility is a huge improvement over barter, where direct exchange was required. Money's role as a medium of exchange is the foundation of all modern market transactions. Money also serves as a measure of value or unit of account. It provides a common yardstick for comparing the worth of different goods and services. Whether you're buying apples or a car, money allows you to express their value in a single, understandable unit price. This makes economic decision-making much simpler for everyone. Beyond its primary roles, money performs important secondary functions. It acts as a standard of deferred payments, a store of value, and a means to transfer value. These functions make it possible to save, lend, and transfer purchasing power across time and space, supporting more complex economic activities and relationships. Money allows for deferred payments, agreements to pay in the future. This is vital for loans, salaries, and contracts. Because money holds its value over time, people can confidently make and receive payments later, knowing what they'll get. This function underpins credit systems and long-term economic planning. Money's ability to store value means people can save wealth for future use. Unlike perishable goods, money doesn't spoil or lose value quickly. This encourages saving and investment, which are crucial for economic growth. The store of value function makes money a reliable tool for individuals and businesses alike. Money makes it easy to transfer value from one person or place to another. Whether you're sending money to a friend or making a purchase in another city, money's portability and acceptability simplify the process. This function supports trade, investment, and the movement of resources across regions. Money also performs several contingent functions that support the broader economy. It enables the distribution of national income, equalizes marginal utility, forms the basis of credit systems, and provides liquidity to wealth. These roles help allocate resources efficiently and support economic stability and growth. Money enables the effective division of national income among different agents of production. Since production involves many contributors, labor, capital, land, and entrepreneurship, money makes it possible to compensate each one appropriately. This function is essential for fair and efficient economic organization. Money helps consumers and producers maximize satisfaction and profits. Consumers use money to compare prices and get the most value, while producers use it to balance costs and revenues. By measuring marginal utility and productivity, money ensures resources are allocated where they're most effective. Modern economies rely heavily on credit, and money is the foundation of this system. Credit allows businesses and individuals to borrow and lend, supporting investment and consumption. Without money as a standard, the complex web of credit relationships would be impossible to manage. Money is the most liquid asset, meaning it can be easily converted into other forms of wealth. Assets like houses, land, or jewelry can be sold for money, which can then be used for any purpose. This liquidity makes money a universal tool for managing and reallocating resources. One of money's greatest contributions is eliminating the need for a double coincidence of wants. In barter, both parties had to want what the other offered. With money, you can sell your goods or services and use the proceeds to buy anything you need, making trade far more flexible and efficient. Money acts as a medium of exchange, a common measure of value, and a store of value. These functions make it essential for trade and economic growth. By removing the obstacles of barter, money has enabled the development of complex markets and the expansion of global commerce. Money has made specialization and division of labor possible. In a barter system, people had to be self-sufficient, limiting productivity. With money, individuals and countries can focus on what they do best, trade for other goods, and achieve higher levels of efficiency and output. Saving is much easier with money than with barter. Money can be stored without losing value, encouraging people to save and invest. Increased savings lead to higher investment, which in turn drives economic growth and development. Money also simplifies borrowing and lending, further boosting productivity. For consumers, money represents purchasing power. It allows them to buy anything, anytime, and compare the prices and utilities of different goods and services. By spending money where it brings the most satisfaction, consumers can maximize their well-being and make better choices. Producers use money to compare costs and revenues, helping them decide how much to produce and which resources to employ. By equating marginal cost with marginal revenue, producers can maximize profits. Money provides the information and flexibility needed for efficient production decisions. Money plays a key role in helping economies recover from recessions or depressions. By increasing the money supply, governments can boost aggregate demand, leading to higher output and employment. This ability to influence economic activity makes money a powerful tool for policymakers. Money comes in several forms, each with unique characteristics. The main types are full-bodied money, representative full-bodied money, and credit money. Understanding these classifications helps explain how money functions in different contexts and why some forms are more widely accepted than others. Full-bodied money is currency whose face value equals its intrinsic value. For example, a silver coin worth 1 rupee as money is also worth 1 rupee as silver. This type of money was common in earlier times, providing confidence and stability in transactions. Representative full-bodied money is usually made of paper and has a value higher than its commodity worth. It's accepted because it can be exchanged for full-bodied money like gold or silver at the holder's request. This type of money made large-scale transactions easier and more practical. Convertible paper money can be exchanged for full-bodied money, such as gold or silver, at any time. Inconvertible paper money, on the other hand, cannot be exchanged for precious metals but is still accepted due to government backing. Most modern currencies are inconvertible but remain valuable because of trust in the issuing authority. Credit money's commodity value is much lower than its face value. Examples include banknotes, credit cards, and bank deposits. These forms of money are widely used for transactions, even though their physical form is worth little. Trust in the banking system and government ensures their acceptance. Token coins are small denomination coins whose money value exceeds their metal value. Representative token money is fully backed by a commodity like gold or silver and is redeemable on demand. Both forms make everyday transactions convenient and secure. Promissory notes are currency notes issued by central banks, promising to pay the bearer a specific sum. Demand deposits in banks are claims that can be withdrawn or transferred by check. Both forms are essential for modern transactions, offering safety and convenience. In capitalist economies, money is central to all transactions. Private individuals and businesses own resources, and money facilitates buying and selling. The pursuit of profit and wealth accumulation drives economic activity, with money serving as the main tool for exchange, measurement, and storage of value. In socialist economies, the state owns and controls resources. Money still acts as a medium of exchange, unit of account, and store of value, but it's used mainly to allocate resources and determine value, not to accumulate private wealth. The focus is on meeting collective needs rather than individual profit. Mixed economies combine elements of capitalism and socialism. Both private and public sectors own resources, and money plays a role in facilitating transactions, measuring value, and supporting economic growth. Governments may intervene to promote social welfare, but private enterprise and wealth accumulation are also encouraged. While money brings many benefits, it also has drawbacks. Demonetization is one such evil. If the government cancels certain currency notes, holders may suffer losses. This risk is especially high with paper money, which relies on government backing rather than intrinsic value. Paper money's value can fluctuate due to changes in exchange rates. These fluctuations can have serious effects on prices and economic stability, making international trade and investment riskier for businesses and individuals. The purchasing power of paper money can decline due to poor monetary management. If too much money is issued, its value drops, leading to inflation. This erodes savings and reduces the real value of income, harming economic stability. Governments can easily print more paper money, but overissuance leads to inflation. When too much money chases too few goods, prices rise, reducing purchasing power and causing economic problems, especially for those on fixed incomes. Money is a powerful tool that has transformed economies and societies. It solves the problems of barter, enables trade, supports specialization, and drives economic growth. Yet it also brings risks like inflation, instability, and inequality. Understanding both the functions and the evils of money helps us appreciate its role in shaping our world and reminds us of the importance of sound monetary management.